So you come into ISA 315, the revised in 2019 standard, and you'll see scope, objective requirements, and application have been highlighted. Guys, I'm going to take you straight here to obtaining an understanding of the entity and its environment. Later on, we will come back to the risk assessment procedures. Okay, so let's go to paragraph 19. Here we've got obtaining an understanding of the entity and its environment, the applicable financial reporting framework, the entity system of internal control. So we're starting with paragraph 19, which is the entity and its environment and the applicable financial reporting framework. Okay, and we have to perform risk assessment procedures to obtain an understanding of the entity's organizational structure, ownership and governance, and its business model, the industry, regulatory and other factors, the measures that they use to assess the financial performance, the applicable financial reporting framework and the entity's accounting policies. And then C says how inherent risk factors affect the susceptibility of assertions to misstatement in preparation of the financial statements. So we've now gone and said all of these factors, and now you have to go and identify the risks, the inherent risks as a result of those factors on the preparation of the financial statements in accordance with the applicable financial reporting framework. In addition, you've got to evaluate the accounting policies to make sure that they are appropriate and consistent. Okay, so guys, as you can see, I've now put down all the considerations, but I've got application paragraphs highlighted from A50 all the way through to A89. So now let's go to A50 and see what it is about these factors that we need to gain an understanding so that we can identify the inherent risks. A50, I've highlighted the auditor's understanding of the entity and the environment and the applicable financial reporting framework assists the auditor to identify the inherent risk factors as a result of this understanding and how there could be misstatements in the assertions. So we've got to obtain this understanding, and this will help us to develop our further audit procedures, so help us with analytical procedures or our audit evidence that we need to get in responding to the risks and evaluating whether our evidence is sufficient or not. So guys, that's why it's so important to gain this understanding. It's going to affect our decisions later on because we have identified the risks. So in terms of the organizational structure and ownership, you need to understand the complexity of it. Are there multiple subsidiaries, components, divisions, or is it a single entity? And the reason we need to understand this is because there could be risks of material misstatement in goodwill, in accounting for the joint venture, the investment, or whatever it is. So that's why we need to understand the structure. We need to understand ownership because there could be relationships and therefore related parties. And we know that related parties need to be accounted for and disclosed in accordance with IFRS requirements. I'm not going to discuss anything IT related, guys, because IT we're going to address in the next test. So you'll see often I don't have anything highlighted or I haven't discussed it for that specific reason. We need to understand the governance and more importantly its oversight of the system of internal control. But guys, this is going to be applicable when we get to internal control, not necessarily helping us with an inherent risk. So that's why I've spoken about this oversight in the applying and adhering to the applicable financial reporting framework, but not discussed internal control because that's going to be addressed later. Understanding the business model, because then you can understand the strategies and, as a result, the business risks that they face. Okay, business risks will increase if there is inappropriate strategies or objectives. They can't achieve those, but they've set them. Or if the market is changing, and as a result, the business should develop new products, but they aren't. Or if there's flaws in their products, or if there's incentives and pressures on management as a result of their strategies. Okay, the auditor must also consider that there could be business risks because of industry developments. That's why we need to understand the industry and the market. If there are new accounting requirements or new regulations. Okay. In terms of the industry and the regulatory and other external factors, we've already noted some risks above, but in addition, you've got to understand what's the market like and its competition, the different types of trends, seasonal, cyclical activity, product technology. All of those are going to impact on whether they are able to keep up with the market, and if there aren't, the risks of pressures because there aren't. In terms of the regulatory factors, what legislation and regulations do they have to adhere to? What industry regulations are there? Tax, government, environmental requirements. So any other additional regulations that are applicable to this entity bring about risks that they are not adhering to those. Other factors, guys, things like interest rates, inflation. All of these will also affect the calculations in the financials where you've got to apply these rates. So it's important that we are aware of those. And in a question, if there's changes to those, you've got to consider the risk that they're not applied correctly, and so the financials could be misstated. Measures used by management to assess the entity's financial performance. This creates pressures to achieve targets. As soon as there's pressures, there's a risk of misstatement due to bias or fraud. Okay, key indicators used in evaluating financial performance. So trends, ratios, operating statistics, period-on-period financial statements and analysis, budgets, forecasts, employee performance measures, comparisons with competitors. So these are ways in which they can evaluate performance. And guys, based on this, in a scenario, if you're seeing these things, you've got to consider the pressures to achieve these targets and ultimately the risk of fraud or management bias because they might not be achieving. Okay, other things they say, if external parties also review and analyze, then there could be pressures created because news and media, tax authorities, regulators, all of these are reviewing these external reports. The applicable financial reporting framework, so just to understand what are the accounting principles, and then just a couple of elements like revenue recognition, how do they account for financial instruments. But guys, it's not only just these, it's everything about the applicable financial reporting framework and the fact that any non-compliance with it results in material misstatements. So there's the risk that they don't comply, which could result in material misstatements. Understanding the accounting policies, the methods that they use, because these could give rise to management bias. And then there are inherent risk factors. They all come about because of our understanding that we've just obtained. So understanding the entity and its environment and the applicable financial reporting framework assist the auditor to identify where there could be misstatements. And these are called inherent risk factors because at this point we have not touched on internal control. So any risk from this understanding is an inherent risk. The complexity or subjectivity of any of the above increases that inherent risk. So to be aware, when we're starting to see that there's estimates and assumptions, there is subjectivity, and so there is more risk, okay, for management bias. And guys, that is understanding the entity and the environment. So now we need to move on to understanding internal control and how that's going to impact the financial statements.